Here is one of the most uncomfortable numbers in all of finance. Over 15 years, roughly 85% of professional, actively managed large-cap funds lose to a mindless index. Not one bad decade, every market. Small-cap funds? Closer to 90%. And here's the strange part. It's not a mystery. 3 structural forces explain almost the entire pattern. But first, notice something odd about time. Over 1 year, only about 55% of active funds lose, basically a coin flip. Over 15 years, 85 to 90%. The longer you wait, the more certain the defeat. Whatever is beating these funds isn't luck, it's structure. And it compounds. Force 1. The fee. A passive index fund charges a few basis points. An active fund charges maybe 1%. The gap, say 70 basis points, sounds like pocket change. Compound it. 1 lakh invested at 7% for 30 years grows to about 7.6 lakh. The same money at 6.3% after active fees, about 6.25 lakh. The fee quietly ate more than your original investment, and the visible fee is only half the bill. Higher trading, taxes on churn, cash drag. The true gap is often 1.5 to 2.5% a year. Force 2 is crueler, pure arithmetic. Active managers collectively, essentially, are the market. They hold the same stocks in roughly the same weights, so before fees, as a group, they must earn the market's return. After fees, as a group, they must earn less than it. This isn't an opinion. William Sharpe proved it with subtraction. Every rupee of outperformance by one manager is funded by another manager's underperformance. The game is zero sum before fees and negative sum after. Force 3 is the quiet one. Career risk. A manager who trails the benchmark badly for 2 years gets fired. A manager who beats it gets a bonus. The punishment is bigger than the prize. So the rational move is to hug the index, hold mostly what the benchmark holds, deviate a little, survive. It has a name, closet indexing. Funds where 80% of the portfolio is the index, charging active fees for it. An expensive index fund wearing a costume. And if you're thinking, fine, I'll just pick the winners, here's the trap. Winners don't repeat. Funds in the top quartile one period land in any quartile the next, almost at random. Past performance has essentially no predictive power. Worse, the statistics flatter reality. Losing funds get quietly closed and merged away, so the surviving record looks better than what investors actually lived. One man built an empire on these 3 facts. John Bogle launched the first retail index fund in 1976 and structured Vanguard so the fund company is owned by the funds themselves, charging a few basis points at cost. He was mocked for selling guaranteed mediocrity. His creation became one of the largest fund managers on Earth. The argument was structural, and structure won. Now, India, with a twist. In large caps, the pattern holds 70 to 90% of active funds trail the index, but in small and mid caps, only about half do. Messier pricing, thinner coverage, more room for genuine skill. So the Indian playbook? Passive as the default for large cap money. Active only selectively where skill has room, and always check the fees and the active share. So the real question was never, can active funds beat the market? Collectively, they can't. That's arithmetic. The question is, can you identify in advance the rare one that will? The honest evidence says almost nobody can. Make passive your default, and make every exception earn its fee. If this changed how you'll pick your next fund, there's more where that came from.